welcome to our first edition of Finance Friday. We plan to do and highlight a lender and topic once a month. We're looking at Fridays, and we're going to try to always put in the subject line so you know to open it and know that it's going to be a good class and what it's going to cover. We always want to have the last 30 minutes to 15 minutes be a question and answer. So that being said, if you have a question during it, just, raise your hand. And I think Malia can see if you're raising your hand.
I can, and you can put it in the Q&A, and then after each little segment that Karen does, we can prompt some questions and get everything answered for you.
So Karen is, she's a lender. She's actually a mortgage lender. So she is able to keep some stuff in-house as I understand it, and also is able to broker it out. The great part about having her in your arsenal moving forward is the word creative financing has been tossed around quite a bit, and she can exactly explain what creative financing really is and how it can help your buyer if they're in a sticky situation, or if they, have only a certain amount of money to put down. So she'll shed some light on the ability of, if you've got somebody who says, I only have 5%, well, you can go to Karen and she potentially can help you out and help your buyer out. She is, again, with Summit Funding. Also, her and her team are not going to sugarcoat anything. They're going to tell you, they mean what they say and they say what they mean. And that is what you want in a lender. So that being said, she's become a trusted advisor in my arsenal. Go ahead, Karen. Thank you. Welcome. I'm so happy that you're here.
Well, thank you. I'm so grateful, first of all, that you asked me to be on here, Therese. I love the term, what's the class called? Financial Fridays or something?
Forbearance, there are no dumb questions. Finance Fridays, financing Fridays.
Right, and there are no dumb questions. So basically, I really kind of wanted to just start off just telling you a little bit about myself. I know that you might have seen a little bio about me, but I've been in the mortgage industry since 2000. And before that, I was in the corporate America. And so I was basically, I was going into big companies. I worked for Price Waterhouse at the time, and actually tearing apart each department to streamline their business processes. Love that work. Just kind of like, getting rid of all the minutia of the extra stuff that they do through a process and a flowing from start to finish. And so that was one of the things that I was able to bring here into my business. I'm very much process driven. And so we're always looking at how we can make things more efficient and more effective, and, close things rather quickly. We can close FHA loans literally as little as about 10 days if needed. But our standard turn time to get docs out is about 21-ish, anywhere from like 17 to 21 days. So it's just all about process. The company and the operational side of things, they are on their normal turn time. So if we can tighten things up at the branch, it just means we can get things done faster for you. So I'm really passionate about that kind. My team's been growing. As you know, it's been a crazy, crazy market. We still focus on purchases all day long, and I've hired a couple people to actually focus on the refinance side of things. But yeah, so it's been exciting. I've been here in the office. I think I missed one day all this last year during this COVID. So I'm a little jealous of the people that get to take some time off, actually. And so I used to also be a divorce mediator back in the day, which actually comes into play here as well, because there are times that, conflict, a lot of people are, scared of conflict. They don't want to have those kind of conversations. Or we have married couples that are, aren't quite seeing eye to eye. And so, I get in there and I try to help people out, just to communicate better, basically, so we can keep moving forward. So anyway, yeah, it's an exciting time. And for all of you guys, I'm sure you have a lot of things going on. We have just crazy market. We don't have enough inventory right now. And so what we're seeing is like a lot of multiple offers, obviously. How are you getting all your offers accepted? So I want to just touch on that as well. We're going to touch on the forbearance piece because the rules have changed from the time that COVID started until they are now. And then I also wanted to talk about the creative financing, like Therese talked about. You know, what are we doing when you have a low appraisal or when people only have 5% down or 10% down, right? What can we do for that? And then whatever else you guys want to hear about. I want to make sure those burning questions that we answer before we end this webinar. So yeah, are there any burning questions that you guys can put in the chat that we can actually address right now before we get started, or another topic you want to hear about before, so I can make sure I touch on it?
I'll monitor that as we go through it, and then I'll just kind of put my hand up.
Okay, perfect. That sounds great. So as far as forbearance goes, when we first got started with forbearance, it was like you couldn't have any lates on anything at all, and you couldn't do anything for a whole year. Okay, so typically if you have a late on a mortgage payment in the past, you literally cannot do anything for a whole year, right? We actually can do a loan with one mortgage late with a good letter of explanation. And so that's the standard process for us. And what's happening with forbearance now is if you've missed like the 3 payments, right, for the hardship, you just have to go back and actually make up those 3 payments. So what we're seeing is that all the banks are putting them on the back end to defer that, to pay it in the end. And that's not helping. And the banks know that as well. So what we're doing is like, okay, that's great that they did that, but let's go back and pay the May and make sure you document that's a May payment and a June payment and a July payment. And once I have that documentation, then we can move forward with a loan. Same thing with car payments. If you've missed car payments or anything like that, they're going to want to see those things caught up, and then we can move forward with the loan. So that's a change from the beginning of time until now. Does anybody have any questions on that? You see any questions, Therese?
No questions so far, Karen.
Okay, all right, perfect. So, you know, and we actually help people with that too. It's like the timeline, when they can do it. Is it possible to take money from here or there, wherever, and get creative in making that happen so we can move forward? The other thing I want to let you all know is that when a pre-approval goes out, at least from our company, right, or from my team, we've already pre-underwritten your file. So it's not just a pre-qual goes out and goes shopping, right? If we give you a pre-approval letter with your DU and your proof of funds, it's because we've really underwritten that file, and we know you're getting keys. So that's what's happening there. Now, the only thing
Can you explain the difference between a pre-qual and a pre-approval?
So a pre-qualification just means that somebody went in and actually just put a little bit of information into, you know, application. They pulled your credit. They just looked at the credit scores basically and said, yep, you have a 700 credit score. You're good to go for $600,000 or whatever it's going to be. And they send you off with a pre-qual letter and you go shopping, and lo and behold, you get into contract and they haven't looked at anything, basically. The banks are notorious for doing this, okay? And the smaller lenders that don't really understand what's all involved. We want to look at, even though you have a 700 credit score, we're going to look at every line item in your credit report, because there could be something in there that, lo and behold, could be a little bit of hiccup for us. And we always tell people we want to pull it now because it's good for 120 days. And basically, that's my point A. And if I have some time to fix that problem, I want to do that here, not here when we got to close in 21 days. So, so it's all really about being prepared. Yes, Therese.
We have a question. My client is going through a loan modification with a very good term after 6-month forbearance. Can he get a new purchase loan for a rental property now?
The answer to that would be no. Well, first of all, we need to get the loan modification papers with the date that it started. And then you need to show 12 months of on-time payments before you can actually do something. So yeah, so it's a twofold. But then he also has a forbearance. You also said there was a forbearance as well.
That's what it says.
The loan mod. So those are 2 different things. I don't know if they're on 2 different properties. But yeah, typically on loan mods, the date that you got the loan mod, so you're going to look at your loan mod paperwork, and then 12 months of consistent payments. And we have to get that actually from whoever the loan mod's with.
So what happens if someone wants to refi with the forbearance, and you said they can put it on the back end, or do they have to do it come clean? Does it matter if it took them, if they did the forbearance back in May and they missed 4 payments? Does it matter if they pay it all today and come get the loan tomorrow?
Yeah, so they can go ahead and pay it all today. Then we just need to get the paperwork, right? So it's all about the solidity of the paperwork. So if you think of an underwriter, basically when we put a file into underwriting, it's like a book. It's almost like you would open a book, right? And what they do is they go over here and they're like, okay, there was a forbearance, right? And so then they look over here and like, do we have all the paperwork to document that forbearance? So if you miss 4 payments, it's like, do we have May, June, July, and August? Yes. And then they'll turn the page. And the next thing comes up, and now it's all, was there the loan mod as well, right? Well, let's look at the loan mod paperwork. Yep, there's the date that it started, and they've made 12 months of solid payments prior to the forbearance, right? So we're good. So next page. Now we have a late, I don't know, revolving credit card, right? And there was like 3 lates on it, like back in 2019, right? Wow, what's going on there? Well, it's kind of obvious that something happened in those 3 months. However, they're going to want a letter of explanation on why those payments were late. Because if you think about it, we're loaning $600,000, right? And we need to be able to like make sure that that file is solid and it goes through quality control. And we actually, Freddie and Fannie will actually, take it, right? Or we're going to have to eat it. And we don't want to eat that loan. So, yeah, so we just want to make sure that everything is very, very documented, very solid, and the underwriters will just give us a call if they have any questions.
And in your experience, how long does it take to get, is that something handwritten to the credit bureaus? Is it something what exactly do you need to have them?
No, that's actually just a letter of explanation from the borrower, like literally just on a piece of paper or an email or a Word doc, basically just saying what happens. And then what will happen is Kayla will actually write it on a Word document. And so when they sign their loan docs, they'll sign that piece of paper before it funds. So that piece of paper will just go in to the underwriter so they can understand what's happening, and they could just keep turning the pages until they get to the end of the book.
Okay, then can he refinance the loan that is going through the modification?
Yes.
As long as he's come to full, as long as he's paid in full.
1 whole year, yes.
Okay. Okay, those are the follow-up question.
Okay.
So then when you are, since we're talking about the term that gets thrown around a lot is it's an underwriting. It's an underwriting. It's an underwriting. So explain, I know you said there's a book and they're doing a checklist. So explain exactly all the things they're looking for, including forbearance, including missed payments, and how to remedy those, for those of us that are agents, how do we help our buyers, or can we, or what does that exactly mean when the file goes into underwriting?
So once the file goes into underwriting, basically for us, it means that we have everything we absolutely need to like tell the story. And so the underwriter, it takes a good few hours for them to underwrite a file. And so they're really going to go through it, piece by piece by piece to make sure that it's secure and that we want to, give that money out. If they have any questions, basically they're going to give us a conditional approval. And so what happens, you guys are looking for a loan contingency date, right? Because you want to make sure that we have our file solid on that date so you can remove them and you don't get a notice to perform. So we always go by that date. So we don't go by your close date. We're always going to do our file by your LCR date, okay? Loan contingency removal date. And so what that means, if we get this conditional approval and it just has we just need to get the hazard insurance, maybe it's not completed yet, right? Or we just need another letter of explanation, or we might need just to lock the loan still, right? Those aren't things that are going to upset our file. So we'll let you go ahead and remove your loan contingencies because it's a great file. It's done. It was put in very clean. It came out very clean, except for just a couple little things, right? If for some reason we get to a point where, here's a great instance. So we just had another branch reached out to me last night, really late, loan officer that is in our company, and they got all the way to docs. It was a self-employed borrower, and in the past, you only needed a couple months bank statements to show your income, deposits going into the bank. Since COVID, they now want 3 months, right? To show that your P&L, because you haven't done your taxes yet, matches the deposits that are in the bank. So let's just say like October, November, December, right, of last year. You know, it used to be you only needed October, November, right? And so the file moves, it gets into docs, it gets already to docs. Now all of a sudden, these have expired and now we need December, and they haven't made any money in December. But their P&L that they gave us showed us something different. So now the December bank statement doesn't match the P&L. Now I have an issue. So self-employed borrowers are very, very complicated. And with COVID rules, they've changed. So I don't know how they're going to get that file done. It's down in LA, but they're working with my processor to see if there's something they can do. But stuff like that. I mean, COVID has changed a lot of rules. We've lost a lot of our bank statement programs that we used to have. We lost all of jumbo last March, and then things are trickling back in. We now just got back 5% jumbo product. It's not pretty. It's a horrible rate. Our seconds went away for a while, so you couldn't do a first and second. So like, for instance, if you're in the jumbo market and you have like a $1.5 million loan and you want to put like $300,000 down. So basically you'll have one loan at the max 20% of the purchase price, or the max loan amount in your county, which is 822 and some change. And then you would have a second loan of about 500. Okay. So these loans went away. When they came, they used to be like at 3.99%, and then they came back and they were like at 7%. It was horrible. And so nobody wanted to do them. And so we put things on hold, right? But now they've come back and they're better. They're back at 4.99. Okay. So these two together allow you to do a jumbo purchase with $300,000 down with no MI. Okay.
Which is what? What's MI?
MI is mortgage insurance.
Thank you.
If you're putting less than 10% down. Okay.
Oh, this is financing for dummies. So
Yeah.
we're going to answer
Yeah.
everyone's questions.
Always looking to make sure no one has
It's
mortgage.
great to ask.
Always no mortgage insurance. So anyway, there's all kinds of creative ways to make something happen. So we just had a situation that there was a low appraisal that came in. It was pretty significant, and they wanted to do one loan, right? Ended up, we were able to do 2 loans with the low appraisal. So it's just, it's having a lender that will get in there and like literally like continue and continue and continue until they find a way to make something happen. We're very upfront. If we can't do something, we're going to tell you. I mean, we're just, we're going to go to the ends of the earth to fight to make.
I'm going to come back to that in just a minute because I have some other side questions on that. But the same gentleman, he just said, sorry, you may have answered this. So it's along the same line of questioning. After refinance the loan under the modification, can my client get a new purchase loan right away?
Yeah, it's been past the period of time. Yeah, it's not a problem. So right now, loan modifications, as long as we have like, the date that it started, right? As long as, so first of all, not in the jumbo market, as long as Fannie Freddie like your file and they say yes, we can move forward. Okay. So there used to be timelines on it. Before you couldn't do anything for 3 years with a loan modification, right? Some loans let you do 2 years, some loans let you do 1 year. It just depends. And now it's basically saying, well, if Fannie Freddie like it, and they say yes, then you can move forward. So it just depends. Every file is unique within itself. No 2 files look the same. I always say, it's kind of ice cream with 31 different flavors, right? In any given month. When someone calls me and said, well, my friend got this, right? And, why can't you just, because it's different. It's not the same. We don't know all the intricacies of that, borrower's file, right? So we're very upfront and honest. We talk to people about right where the market sits. We tell them what we can do, what we can't do. Sometimes we have to do a little credit report pair to bring their rate up. We're always looking to get their FICO score up to get them a better rate, right? And so there's times that we can like, listen, go use that card that you're not using for like 30 days and your interest rate will get better because you're
Pay it off.
or pay it off, right? Like there's all kinds of things that you can do, right? So we really look at all the intricacies of every single file, and we'll run different scenarios and different wizards, and we'll call an underwriter if we have to. And like, we've been here long enough at Summit Funding that like, if I had to, I could go straight to the top and get my questions answered. So it's good to have that kind of leverage in your company where you can talk to anybody you need to get the answers that you need. Yeah.
Okay, so now going back into what you were talking about with the appraisal, and again, if someone has, you guys can ask any questions you want. So going back to the appraisal, explain how you're able to explain exactly the purpose of an appraisal, first of all.
Okay.
Why there's such a discrepancy, why it's their opinion, and what do you do when it comes in low? How are you able to modify it now that you no longer have the collateral at what that appraiser said it was worth? So in other words, I know you raise the interest rate, but how does that protect you?
Okay, so first of all, an appraisal, when we have a purchase, we always have to order an appraisal. We are looking for that appraisal to come in at the value you're in contract at, okay? And we're looking for it to come in clean because whatever's on that appraisal, they call out with the naked eye that needs to be fixed. Like typically it would be like a broken window, or I don't know, what are some of the things that you've seen on appraisers that have to be fixed?
No smoke alarms.
No CO2. I don't know. There might be,
a hole in the floor.
Water. Yeah. Something that's very glaring, like you would notice it, something that would, a 4-year-old could trip over. It's health and hazard of like, if you think of a 4-year-old child, right? Those things will be written out on that appraisal, and those things have to be repaired prior to funding the loan. So when we get an appraisal, right, and it calls out some stuff, we're always like, hey, Therese, these are the 3 things that need to be fixed. Like, let's get on those things, right? So we can make sure that they're done in a timely manner so we can fund the loan and close on time. Also, we want it to come in at value. So let's just say it doesn't come in at value, right? But you're putting so much money down, more than 20%, right? That it's absorbed in there, okay? So everyone's like, oh my gosh, I have to come in with an extra $20,000. Well, no, you really don't, because the purchase price stays the same, but because you're putting so much money down, we're only gonna loan on whatever's lowest appraised value or purchase price, okay? So that means that if you're putting a bunch of money down, your loan amount's already below the threshold where it needs to be. So nothing changes in your file. You don't have to come in with any other monies, okay? Now, if you're only putting the minimum down and appraisal comes in low, let's call it $5,000, and you can't negotiate those terms with the seller, then you would have to come in with the extra $5,000 because they still want their money, and that would become part of the closing costs. So if you're putting more than the minimum down, it'll get absorbed, right? If not, it's going to be part of the closing costs, okay? Now, if for some reason, let's say it was 20% and it came in low, we then would look at doing 2 loans, a little less than 20% down to make up the difference. And we would like do a first and a second loan. Okay. So we're always looking at, especially if you remove your loan contingencies, right? We're always looking like, great. However, if it comes in low, what's our plan B? And we've always talked to the borrower about that, because that's one of the things that comes up. Hey, we removed our appraisal contingencies. What does that look like if it doesn't come in? That's something we're always talking about, like at the very beginning when you're writing offers, okay? Which is another thing that we like for you to do is when you're ready to write an offer, let us know, because you're always asking how fast can you, get the loan done? How fast can you close? I'm going to remove my contingencies. I'm going to remove all my contingencies. Are you okay with that? So we like to collaborate with you so we know that you're writing a really clean offer and we can stand behind it no matter what.
So along those lines, in our market, as you know, we have to pretty much go in non-contingent. We as agents don't like it, but
we hate it.
we hate it more than you do. I can promise you that. So I know it puts a lot of pressure on you and any lender puts a lot of pressure on anybody. So what is your advice to an agent who knows that they're going to have to go into that? So would you say that if, I know it's going to be different depending on the files and whatever, but like 20%, if you're going to go non-contingent, you can pretty much feel safer going in non-contingent if you're putting 20%, or anything less than that, you know, just to protect the buyer?
I would say if you're gonna do non-contingent, I would talk to the borrower about, do we have extra funds somewhere just in case? Can we get 401k? Can we get some stocks? Can we just be prepared, right? So we're always talking about that at the front end anyway. Can we get some gift, right? Do you have a family member that could help if we get in a situation? There was another, you asked a twofold question. So can you say that again? Because I just went back and I forgot what the other part was.
Well, before I forget, I want to get, I've got another question here before we get too far past it. I think this goes.
Oh, I know what it was. It was non-contingent, you know, how I feel about it.
I know we don't like it.
Well, what I'll say is, if you're going to do that, I always look at, well, what's the backup plan? Are you going to get inspections? And is there something that we could pull out if we needed to? Because I would never want their deposit to be at risk, right? So I'm always looking at not putting their deposit at risk, and how can we take care of that in the what if scenario? Those are conversations I know that you're having with your borrowers, and I'm definitely having them with them, because at the end of the day, we want to get the file closed for you. You know, we want to get all you guys paid, and we want to get them in a home, and that's the bottom line, and that's what we care about the most. So, I mean, there are times that, you know, I might have to do, like, you know, put some money in because we're off, right? Or I have to buy the rate down because that's what works for the file. And then all of a sudden we don't have any more money because now we got to put it towards a low appraisal, right? That doesn't happen hardly at all. But I'm just saying, there's times where I'm like, you know what, that's fine. We'll help you out, right? That's a one-off. But we're going to do whatever we can to make the file work and have those hard conversations up front, which is really important. So everyone's on the same page.
So another question, how does refinancing a home affect a buyer purchasing another home, or does it?
The only thing it does is if you're going to refinance one of your houses, right? And then you go to purchase another house and you're keeping that house, we're just going to change the payments in the new file based on this. Some people will take money out here to buy this house. We just actually do them. We have two simultaneous files going, and we just make sure that they're always they're always responding to each other.
So if they are taking money out to buy that property, does that affect their LTV? Because now you've got like this file.
We always look at, when someone calls us, we are always looking at everything to make sure it works, and we're having all those conversations up front before it gets moved forward. Like, I would never have you go ahead and put a contract in before I ever got this file like concrete, and I've had those conversations, and you know how much they're getting out, and you know it's all working, you know, the motor's running very smoothly, right? If there's a question in my mind about any file, I'm not going to feel comfortable moving forward. We want to make sure we cross all our T's and dot all our I's, and we're solid. Because at the end of the day, it's your reputation, it's my reputation, it's you know, real estate's a family, it's a relationship, right? Between everybody who's in the collaborative effort, right? So we just want to make sure we're taking care of everybody.
Agreed.
Everybody's reputation stays intact. And I tell buyers that, I tell borrowers that too. So if I get somebody that comes to me and they have a lender from who knows where, and I don't know who they are, you know, or not a lender, and they have a realtor from wherever, I'm going to say, hey, listen, let me refer you to somebody because I want to make sure you're taken care of. You know, these people don't know this market. And you'll be surprised how many times we can turn, you know, people, and they listen to us because they trust us.
So, a couple questions that I think other people are going to want to benefit from. Are you having any issues with, we do have a lot of buyers who are from other countries.
Mhm.
and they're here on work visas.
Mhm.
How does that impact how you can loan against them? Do you have to double check with their employer to see how long that visa is good for? Like how does that impact how someone can get a loan?
Okay, so there we have in the jumbo market, and we have a new jumbo lender that has given us really great rates. Okay, and we just came up against this. We had somebody who was a work visa, okay, and a first-time home buyer. Well, they don't want that. That one particular jumbo lender doesn't want that. So then we went to another one. Okay, so a work visa, the few things we look at was like, first of all, when we take the loan app, we're always looking at, is it a work visa? And we need to get the paperwork. If it's a DACA paperwork or the visa, we want to make sure it's not expiring in the next 6 months, because we know it takes a while to get your new paperwork in and get it, the next one. So you don't want to come up against, it's expiring in 2 months and I still have my paperwork in, because that could take 6 months to get it and then you can't move forward, right? So we're looking at that stuff. It's like VA. Do you have your eligibility? Are there any hiccups? Can we get it? Right? If they
We
don't
do have a
have
VA
it,
question, by the way, so
Yeah.
that's gonna tie in nicely.
yeah.
Keep going.
So I have somebody who we are attempting to refinance, and it started last year, and he needed to get his disability paperwork from the VA. We're like, that's great. So we did the PES report. He had some foundation work to do, and it was going to take months to get it scheduled and do it. Now it's done, and we're still waiting. And so, we just talked to the borrower the whole time, and we're waiting for it. And so everything's ready, and we're just waiting for that one piece of paper. But everybody knows about it. Everyone's on the same page, right? So yeah, so it's stuff like that. We're always looking at when things expire, what kind do you have? Do you have a green card? What, it's all those things. And then we look at all the different loan programs they'll fit in, and then which one's the best one for you. So for instance, if I have an FHA buyer, right? And if I have a buyer and they fit in, I'm always looking at what's the FHA, what's the conventional. Because if they have a great credit score, I'm not going to want to do FHA with 5% down, because their MI is going to be less because they have a great credit score here. With FHA, it's the same mortgage insurance across the board, right? So their payment could literally be $300 less over here with the same amount of money down. So we're always looking at both scenarios, right? We're looking at all scenarios. It doesn't take that much more time if you know the loan programs and you're a good technician.
So one of the questions in the chat box, it's pretty broad, but maybe you can, and I know that you've helped me with the VA loan. So he wants to know what the issues are with the VA loan. And I think there's a follow-up to that. And what's a great credit score? So I think what's a great credit score based on the FHA, I think was the question. So let's answer that. And then a second question is, what are the issues with the VA loan?
Okay, so FHA, depending on your lender or your company, can go down to like 580, right? But right now the rules have changed a little bit. So from 580 to like 640, it's like 10% down right now. And then 640 is the magic number for an FHA forward. And you'll still get great rates. I mean, under 3%, okay, for FHA. For VA,
is there another break after 640? Is there another break in the rate after the 640, or just does that have to be over 640?
It's about the same. It's a first-time homebuyer product, so they put the rates where they need to be, right? For low, because they know they might only have one credit card. They might just have no credit cards and an auto payment. And so your credit score is not going to go as high because you don't have that credit established for a long period of time. So that's, part of that whole thing. Also, all gift, you get all gift to cover everything on that loan, right? The VA, so VA is 620, great credit scores, no MI, 100% financing, right? You're going to need a pest report. That's the one thing that is very different. And there's some fees that are allowed and some fees that aren't allowed for the borrower to pay for. So the seller has to pay for some of the fees. And I have a whole list that I can, send you that shows allowable fees and non-allowable fees for VA. But the pest report is the key. So we don't need a pest report for anything else. So what I always say is when you're writing up your RPA, right, don't ever write anything on the lines. If you just want to say, that the buyer is going to get some inspections and whatever, you check all the box, but don't write anything in there, because as soon as you write in there on a jumbo loan that you're going to get a pest report, then we need to get a pest report. underwriter's going to ask for it, right? So we don't want you writing anything on there, okay? Because that's the only loan that needs a pest report. No other loan needs inspections, no other loan needs pest reports. It's all going to be based on the appraisal and what the appraiser calls out to be repaired prior to funding, okay?
So as I understand it, correct me if I'm wrong, the buyer cannot pay for the report, but the buyer can pay for the repairs.
Yes.
Okay, that I just wanted to make sure that we were
For
clear
VA.
on that. For VA.
Yeah.
And FHA has no requirements for pest or any of that. So VA
Now,
is
there
the,
are some requirements for FHA, like you can't have a fence that's, falling down. I mean, there's more health and safety for FHA, but let me tell you, the appraisers are looking at properties now, like as if it was all FHA. Okay. I mean, you don't get in the attic if it's not an FHA, right? They might just, you don't have to get up there and look around. There's certain things you don't have to do. The other thing I'm going to say is if you guys have addendums or addendums during the course of a contract, if you have, let's say you have addendum 1 that says you're going to get some closing costs, and then you have addendum 2 that says you're going to tent the house, right? Because the pest report came out. We don't want this. We want 1, and we want a 1A or 1B or 1C. I don't want this one because the underwriter is looking for, things in sequential order. So if you give me a 1 and a 2, and if you give me a 1 and a 3, and you don't give me 2, they're going to want 2. That's why I said, like, do a 1 and then give me some letters. And if you have something that you don't want us to see, but I want to know about it so I can steer clear of it, make that a 2 or make, So the good thing is just call your lender and talk to them about things. So everyone's like, I don't want to tell you. I'm like, no, tell me. I want to know, because if you have a pest report and you're going to get a house tented, I don't want to send my appraiser out on the day you're going to get it tented. I'm going to want to know about that. So we can kind of steer clear.
okay. So switching gears again, why does it take, and again, these are answers that I do know the answer to, but I want you to explain it to our audience. Because I know these questions come up all the time. So what is a CD? What does it mean when it's going out? And why does it take 3 days?
Okay. So a CD is a closing disclosure. Okay. And so the flow of, contract to close, right? So basically we get into contract, we get the fees from the title. We can't really start a file, disclose a file to a borrower until we have fees. So if we don't get fees in 24 hours, we're up in arms, especially if you have a 21-day close. We're like, we need fees. Therese, can you please call them? I need fees. I need, every day is a day lost, right? So we get the fees, we put them all in there, we disclose the file, we go over the file with the borrower. And so then we get the file into underwriting, and I'm just being very, high level on this, okay? Goes into underwriting, comes out the next day. It's a 1 day in underwriting for purchases, okay? Then we go back to the borrower and we tell them what we need. If we need something from you, we get it from you. We're very urgent about it. We're like, if you can get those things to us, if it's a Friday by Monday, right? Because we want to check all the T's and dot all the I's. We want to get back into underwriting literally on Monday, if not Tuesday. And it's 1 day to get things cleared, right? And then all of a sudden now what happens is I get to lock your loan in. So I'm calling the borrower, I'm going over the rate, locking in the loan. So then what happens once you lock in the loan in, then a loan estimate goes out to them. Now that's just telling them that you locked the loan, okay? They get that in the very beginning of, the fees and, the rate that we have in the file. But then when it actually comes out of underwriting, we really lock the loan in, and I may lock it in over here too, but I'm always on the phone discussing it with them. I tell them you're going to get a loan estimate. You need to just go in and acknowledge that loan estimate that we locked your loan in. Okay. That allows us then to get a CD out. Okay. You can't put the CD out before you lock the loan. So this closing disclosure then can go out, and then we call the borrower. We go over it with them. Okay, it's all the fees and everything. We're getting ready to get our loan docs out. So that's what that CD is, okay? And that CD, we ask them to sign on a certain day because literally they cannot sign their loan docs for 3 days. Now this came about because back in the day when people were just shoving docs out, putting it in front of people and like sign, and they're like, wait a minute, this is not what we signed up for, right? That's why this all came into play, right? Because it's just bad stuff was going on. And so now they have 3 days to talk to their lender, go over the things with their family, make sure everything's copacetic, right? And then basically they sign it. And then literally the next day is day 1, day 2, day 3, we can sign the CD. Okay. I mean, not the CD. Day 3, we can sign the loan docs. Okay. So we're signing loan docs if we have to on that day or any day after, but not before. So you really have to be very in your calendar when you have a really fast close date, like this has to happen and this has to happen and this and this and this, it has to sign on this day so we can literally fund it the next day and close it the next day, you know, or it might be a situation where we have to sign those loan docs, carry them back to title, make sure they fund it that morning and close it the same day. So, you know, the lender just needs to be on it. So when I get a call from somebody I'm working with, and I'm like, oh my God, I'm so frustrated. I'm working with a lender and I don't even, the docs aren't out yet. We're supposed to close in 3 days. And I'm like, oh, what's going on? Talk to me about it. Call them, you know, I'm giving them tips on how to get it moving again. But that's pretty much the timeline. CD signed, 3 days later, sign their loan docs, it'll fund and record.
Okay.
Yep.
What is the difference between and advantages and disadvantages to both? What is the difference between a mortgage lender, a mortgage broker, and a big bank?
Okay, so a big bank is a big financial institution, and they basically do a lot of different things, right? I mean, they have lots of different things. They do life insurance, they do financial planning, they do like depositories and all that stuff. So basically, their loan officers aren't licensed, by the way, they're not required to be licensed, okay? So in my experience, they really just do paperwork. And then eventually it goes somewhere into underwriting and yada, 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 right? So that's a big bank. Now, big banks have lots of money, right? So typically they can, you know, lower their rates a little bit and get a little bit better than we can. But that doesn't necessarily mean that they close something as fast as you need it closed or that you're going to get great communication, okay? So there are times that we, as a banker, we're a banker, okay, that our rates might be an eighth higher, you know, because we're a private banker and they can do what they want and they can use other people's money and, you know, so that's the banking side. And then we're a banker. And so what that means is we have our own warehouse lines. So we do everything from start to finish. Okay. So we actually fund the loan. We actually, you know, we may service some of the loans. It's private, you know, we're a debt-free company. I mean, President CEO, you know, believes in that. That's why we have 4 warehouse lines. We can do a lot more internally. And it's my team that does everything from start to finish. So I know everybody who touches that file. Okay. So that's different than a bank where you don't know what's going on and you're not probably getting really great communication. Some loan officers in banks are amazing. I will say that hands down. And some of them are, I know them and they're my friends. And then the broker side means that they don't do anything internally. Everything goes out. Okay, so some of the ARM products, right? Like Union Bank, Fremont Bank, right? We have the capacity to send them out. Like we have Redwood Trust, and but we do all that stuff in-house. There's very little programs we have that we have to send it out to them for them to underwrite it, for them to draw the docs, for them to do everything, and then we're waiting around, right, to get things back so we can fund the loan. Okay, so everything goes outside of our control, and then you know you're just waiting around, right? We have more control as a banker to do everything internally, and we can get things done faster. Like I would never be able to close an FHA loan in 8 days if I had to send it out to someone. It just wouldn't happen. So it's for as far as a banker like us, we can give you better service, better updates, move fast, make stuff happen. Like I can call internally my CD drawer and say, we're up against the fence and I really need to get the CD out tonight, and I can get someone to stay and get it out that night. And then I tell the borrower, hey, you gotta sign this thing before midnight, right? And so they were like, have you signed it? I'm texting, have you signed it? Have you signed it? Make sure you sign it, because I gotta sign your loan docs 3 days so we can close on time. Like, we take really great pride in closing on time. I stay up at night, stressed out if I'm, have they signed the CD? Can we close on, we always close on time though. You're muted. You're muted. You're muted. There you go.
Teach a Zoom class.
That's okay.
I've got my washer going in the back. I don't want you to hear that.
It's okay.
So this might need a secondary question. The question is, are you going to discuss the impact of forbearance on buyers and the real estate market? So I'm not sure if you mean a buyer who has done a forbearance on a departing property. Maybe that's what the question is. So if you've done the forbearance on the departing property and you're buying a new one, I'm assuming this wouldn't really be a first-time home buyer. So
yeah, make it well, because they put it on the back end, right? But here's what would happen. We would know that before you ever got in contract.
So you would know that. So you've got buyer coming in. Hi, can you help me with my buyers? And then you would ask for their documentation and
Well, their credit, see that they have late payments, and we would go, hey, you can't go get in contract right now. We have a lot of work to do.
Okay, so they would need to catch up on those payments.
Mm-hmm.
And then is there a period? So I think this was one of the questions.
Not a cooling off period, if that's what you're asking.
You would just need the paperwork from said forbearance information.
Yep.
Once you got all that, is that a week? Is that 2 weeks? Is that something that you get? Is the buyer
right away. We just put it right in.
Okay. Does the buyer get you that information from?
The buyer would have to get me that information. They would have to go back. We had a situation where someone was buying a house, okay? And the boyfriend that was buying the house with her missed 3 truck payments, okay? And I said, hey, dude, you got to make up those truck payments. Go to the credit union, and because they put them on the back end. They go, why do I have to make up for them? I said, well, you need to. So you need to go to the credit union. You need to give them 3 checks, right? May, June, and July. Make sure, take copies of them. Make sure they document them, that that's what they're for. Whatever they do on the back end, they can rectify that later, but this is what we need. So I got all that paperwork that day, sent it in, and we were able to fund their home.
So that would be the same with the forbearance. Here's my May payment. Here's it's dated. It went to this one. Here's my June payment. It's dated. It went to this one. Here's my whatever.
Got to be very well documented.
Connect it all. And are there late payments on any of that?
Late payments? Are you talking about a late, like a 30-day late on a credit report?
A late payment. I know the forbearance exists to at the time, because nobody really knew what was going to happen. But are there late payments? So if someone's mortgage payment is, $2,500, is there a late payment on that, or is that bank specific?
So the only time you would get a late payment on something is if it hit your credit report. So I always tell people, like,
but it wouldn't in forbearance, right? It doesn't hit your credit.
No, so it's not late. You just have to catch up on it. That I understand what you're saying. You just have to make those payments. Yeah.
Okay.
And they're already late, right?
So the person who made that question, if you have a follow-up question to that, please put it in there, because I'm hoping that's what you wanted to know, because we want to make sure you get your questions in.
And they can also email me, right? I can put my email, do you have my email? I can put my email in the chat.
We can send it out once the webinar is concluded and everything's been uploaded. We can send out a follow-up.
So here's another one. It kind of has twofold. My client missed mortgage payments 3 times in the last 2 years for the house she owned with her husband, not because of a hardship, but by mistake because she was going through divorce. Can she get a new purchase loan now? She's financially very strong now with savings for more than 30% down payment.
So one late.
Payments are made. They were just
late in the last 12 months.
So one late in the last. Otherwise you won't,
Why you want to make sure the lender pulls their credit. So my suggestion, like with anything, is like I always tell people, let's get your credit pulled so we can see what the credit looks like, right? And then one late payment in 12 months. Okay.
so in this scenario, it doesn't sound like she can get a purchase
Well,
loan.
if she had more than one in 12 months, you'd have to wait to the very last one, right? Or the one before one for 12 months. So just think of 12 months, one late, right? So like if she had a late in May and she had a late in January and we're in February, right? You would want to wait. She could do it now, one late.
So if she wanted to get that cleared, she'd have to go to the credit bureau and write a letter and explain her
Yeah, and it
hardship.
would be very, very difficult.
No, and yeah, I know.
The best time to
I've
do
known
them, by
people
the
to do
way,
it.
is the end of the month when they're closing their books and you can cry a lot and get something done.
Okay.
Yeah.
So I'm not seeing any other questions in the chat. I'll just keep asking because I've got other
I
questions.
do have one thing to
Yeah,
say
sure.
about this crazy market of like, multiple offers and stuff. So for us, as you know, when you write an offer, I always make it mandatory that you send me the offers on our buyers, right? Because if you're sending me that offer, then I know what's going on. And I always do a courtesy call to the listing agent just to actually say, hey, you got my pre-approval for our borrowers that Therese wrote a very strong offer. I just want to see if you have any questions, without giving confidential information. Obviously, borrowers are, and I always praise them on the listing. I'll pull up the listing. I'm like, amazing listing. Congratulations, right? Because it's a big deal. And the whole thing is, you want to get in contracts to get everybody paid. So basically, I'm just asking them point blank, do you have any questions for me, right? Yada, yada, yada. And sometimes they said, we got like 10 offers. And like, you're the lowest offer. And I'm just like, well, can you just tell me the range that we would need to be in? Now, they won't tell you that, but as a lender, especially if I know them, right? They may tell me like, you're off by 10 grand. I'm like, all right. I said, is there anything else that, the seller is looking for that maybe we're not aware of, right? And they're like, you know what? Well, we just found out that one of their kids is in the hospital and they really need like a couple extra days or something. And I'm like, well, let me get back to Therese and I'll just, instead of you giving her a call or vice versa, let me get back to her and just tell her what's happening, right? So all of a sudden I'm creating that collaborative effort for all of us. And a lot of times that offer will get in contract above other ones. Just because we went over and above by calling the listing agent, just seeing if there's anything else that we need to know about,
It does make a difference for sure.
Yeah, it's making a difference,
So I have a couple more questions here. Yeah. If the buyer does not have the money to bring it current in forbearance, hold on, the question keeps moving on the page, and there's not a document of the payment paid, but have money coming out of the sale of the present residence will pay after the sale, can you do the loan for the new?
Yeah, you know what? I've not come up against that. That's a great question. And you know what I'm going to do? I'm going to Teams my underwriter lead and see if she can answer the question for me while we're on.
And then while you're doing that, somebody wants to know how long your loan approval is good for. Is it good for 90 days, 120, 60?
Our loan approvals, what I tell people, our loan approvals is as good as nothing changes that's in the file. You haven't lost your job, your income hasn't gone down, right? And you haven't made nothing's happened to your credit. Like you haven't made any late payments, right? So your credit's clean. The assets are still there that we need. You didn't like go and buy $100,000, Camaro or something like, and you still have your job. That's it. So remember, it's all the three things. It's credit, right? Income and assets. And if those things are intact, literally your pre-approval is good for a long period of time. Now, we always stay in touch with everybody. We call them every week to say, how you doing? Are you going shopping this weekend? Is there anything that we can like let Therese know or whatever? And we're always updating them. There's always the question has interest, up and down. So we're always looking, making sure the file is current. And we're in contact with them all the time. I mean, there's a lot of times that people like decide not to move forward right now because there's not enough on the market. And like literally realtors will forget about them. And we keep in contact with them. And 6 months later, we're like, hey, Therese. And that's not you because you you're in touch with
Right.
all your borrowers, but some people, right? I mean, that's not you. And I'm like, what? And I'm like, yeah, I know you forgot about them. However, they're ready to rock and roll. They did exactly what we asked them to do to get their credit score up. And now, they're ready to do shopping again,
Okay,
so.
well, and got 2 minutes here. Can you explain the difference between when someone has their interest rate and what the APR is?
Okay, so the APR basically is, if you think of it this way, the interest rate is the note never changes. If it's a 30-year or 15-year or whatever it is, right? Never changes, right? It's good. Nobody can change that for the life of that loan, except if you sell or you refinance. And the APR basically is actually taking all the cost of the loan. Okay. It's like taking all the costs and like putting it in there and then forecasting over a year that this is what the rate would be. With all of the costs, seller, buyer, everything, whatever's in that actual loan estimate. Okay, that's what that is. I mean, that's the Reader's Digest version.
No, fair enough. That's good
Yeah.
enough.
Mm-hmm.
So like I said, I wanted to get some of these questions that I know people know they have in the back of their head. They just don't want to ask them.
Yeah, I'm gonna see if I'm gonna get this question for you about the forbearance thing, because I haven't come up against that, but good question. And I'll make sure that I get back to you by end of day and then you can shoot it out.
Okay, so I don't want to call out your name who asked that question, just because I just don't want to. I don't know that you want you to know that it was you that asked the question. So if you want to, you can put your information into the question and answer part, and I'll make sure that Karen gets that answer to you. Fair enough? Or you can email me offline, tferrara@kw.com.
Or they can call me. I mean, my number is 925-998-1360 is my cell number, 925-998-1360. Yeah, give me a call or they'll put my email there and you can email me as well.
Okay, I've got it. I've got the number here, so I'll make sure he or she calls you. And then cash buyers, money under the mattress, how do you treat it?
Okay, so the only cash buyer I had like that, money under the mattress, was my own family member. I couldn't believe it. She's like, I have money. I'm like, it's under my mattress. I'm like, you're kidding me, right? Like, we can't use cash. It's in safe deposit box. Cash is not king when it goes towards a loan, okay? However, my sister is so good and organized that every time for 5 years that she went and put a paycheck in the bank, she literally, the little deposits you do, she would put that she wanted $500 out. She kept all of those deposits with dates every month for 5 years. And literally I was able to count up that much money, and that's what she used. So as long as it's documented really well, even if it's cash, right, then I can use it. So that's the answer. And it only happened once, and it was my own sister.
That's interesting.
Yeah, I know.
I wouldn't even have thought of that. Good question.
The whole thing
I know
is,
everything has to be documented.
yeah, if you sell a car, keep the pink slip, keep the check. Don't let anyone give you cash, right? Because you can't use cash for that. So you want to be able to get a check, take a copy of the check, put the whole check in the bank, then we can use that, right, as down payment or cash to close. Okay, so just think of every piece of money you have to document. There has to be a paper trail because of all the bad loans and the laundering of money. That's where all that came from, right? So large deposits, if you have like $20,000 you put in there, we got to like track it. Where'd that come from?
Understood.
Yeah.
Well, we are at the end of our hour. I thank you so much for your time.
Well,
I know that you're busy. I know that you're busy and your team is busy, and we all appreciate you taking the time to come out and volunteer your expertise.
Anytime.
And if anyone has any other questions, again, you want to say your phone number one more time?
925-998-1360. That's my cell number.
And we'll also send it out with the recording as well. I'll send a nice email to everyone who attended with Karen's